In this week's market update, trade fears trigger a nervous start to the third quarter, politics is in focus on both sides of the channel, and Tesco and Carrefour join forces in a defensive purchasing pact. The third quarter of 2018 started on the back foot as trade war fears dominated market sentiment. The developing tensions between the US and both China and the EU hit equity markets around the world as investors worried that new tit-for-tat tariffs make recession more likely. China was hardest hit, with the CSI 300 index falling by nearly 3% on Monday. That was the fifth worst market session in Shanghai and Shenzhen this year. The fall more than wiped out the 2.6% gain on Friday, which itself had failed to prevent a 2.7% drop for the week as a whole. Japan was also off more than 2%, and the Korean Kospi index fell 2.4%. Once trading started in Europe, investors picked up on Asia's negative sentiment, focusing on the weekend's warning from the European Commission that it could impose tariffs on up to $300 billion of US products in retaliation to Donald Trump's threat to impose a levy on car imports from Europe. The German DAX index was off more than 1.3%, the FTSE 100 fell by about 1%, and the broad Stoxx 600 index was down 1.1%. Later in the day, the S&P 500 bounced back from early losses, but this morning, Hong Kong came back from closed markets on Monday and saw its China Enterprises Index play catch-up, down 2.9%. So it's been a rough start to the second half. The back and forth of trade threats shows how rapidly trade tensions can spiral once protectionism takes hold. And the market reaction confirms how damaging a reversal of globalization might be. The key reassurance for equity investors after nearly 10 years of rising share prices is that recession remains a distant prospect. But if trade tensions bring forward the prospect of a meaningful economic slowdown, then a major support for the market disappears. The weak start to the second half follows a first 6 months which defied bullish expectations at the start of the year. Equity markets have been volatile and, broadly speaking, moved sideways, with a few notable exceptions like the US technology sector. The broader US market was up just a few percentage points. The FTSE 100 ended June pretty much where it started January, and Europe and Japan, popular markets at the turn of the year, disappointed, down a few percent year to date. Worst hit in the first half year have been emerging markets, hit by fears about trade talks and the expectation that rising US interest rates will boost the dollar. That's typically a bad backdrop for riskier emerging markets. China has suffered more than most as trade wars have compounded the authorities' decision to rein in credit availability. From the January high, the Shanghai and Shenzhen markets have fallen into bear market territory. That's down by more than 20%. What's also becoming clearer is that tariff threats bring other consequences in their wake. In China, for example, the renminbi is clearly being allowed to depreciate in a bid to make the country's exports more competitive. The Chinese currency has fallen to 6.7 to the dollar after one of its weakest months ever against the US dollar, which is being treated as usual at times of geopolitical stress as a safe haven. The big fear for investors is that a devaluation of the renminbi triggers capital flight from China and triggers market volatility like that in the summer of 2015, when the Chinese currency last fell sharply against the dollar. That resulted in a significant market retreat that continued until early 2016. The dollar is rising against most currencies, with the euro and pound both falling by more than 0.4% on Monday. The yen, also embraced by investors as a safe haven, is broadly flat against the dollar. But emerging market currencies outside China are also under considerable pressure as investors weigh up the disruptive potential of less global trade and a stronger dollar, which increases the cost of funding borrowings denominated in the US currency. The focus will remain on the dollar later in the week when American investors return from Wednesday's Independence Day holiday to Thursday's Federal Reserve meeting minutes and then Friday's non-farm payroll employment data. The Fed minutes could give some insight into future interest rate moves, as the June monetary policy meeting was the first at which signals emerged that rates could rise a total of 4 times this year. For now, trade disputes look like playing second fiddle to a strong jobs market and the boost to growth from tax cuts, which has sent inflation modestly above expectations. As for the employment numbers, attention will no doubt be on Donald Trump's Twitter feed, as he preempted the announcement last month by saying he was looking forward to the figures, which duly emerged better than expected. This month, a slight slowing in the rate of job creation is expected to just under 200,000, with the unemployment rate staying at about 3.8% and average hourly earnings running at 2.8% year on year. Now, trade fears have been compounded in Europe by political concerns on both sides of the Channel. In Germany, Chancellor Angela Merkel's position looks vulnerable thanks to a breakdown in relations between her party, the CDU, and her coalition partner, the CSU. The two are divided on immigration, which has re-emerged as a fault line in the EU. Horst Seehofer, Germany's interior minister and the leader of the Bavaria-based CSU, threatened to resign if Mrs. Merkel does not take a firmer line on migration. A last-minute deal was struck yesterday to patch up relations, but there's clearly no love lost between the two. The arrival of more than 1 million refugees in 2015 has led to the rise of the right-wing Alternative for Germany party, and that threatens the CSU dominance in the southern German state of Bavaria. Meanwhile, in Britain, the last 2 years' tortuous progress on Brexit reaches crunch time this week as Theresa May gathers her cabinet at Chequers for a make-or-break summit to agree Britain's post-Brexit customs arrangements with the rest of the EU. The Prime Minister has apparently accepted that the two proposed solutions on the table at the moment will not fly, and is working up a third way that she's shared so far with no one that matters. That means she's essentially rewriting her whole Brexit strategy at the 11th hour in a bid to strike a deal with Brussels before the October deadline. Without a viable customs plan, Britain will be forced to remain in the EU customs union indefinitely under the legal backdrop agreed last December to avoid the reimposition of a hard border in Ireland. Now that would infuriate the hardline Brexiteers, for whom leaving the single market and customs union is a red line issue. Adding to the complexity of the Brexit drama are stories over the weekend that Jeremy Corbyn, the opposition leader, is coming under increasing pressure from Remainers within Labour's ranks to shift position and insist on a people's vote on an eventual Brexit deal. A long-time Eurosceptic, the Labour leader is at odds with many of his MPs, who in turn are at odds with many of their Leave voting constituents. So, in short, Brexit remains a complete mess on which the clock is ticking fast. Also in focus this week is the oil price, after Donald Trump tweeted over the weekend that he'd spoken to Saudi Arabia's King Salman about boosting oil production further to help ease the price of crude. This is the first confirmation from the White House that it is twisting the arm of the world's leading oil producer, Saudi Arabia, as a 4-year high in the oil price builds on trade fears to threaten global economic growth. Saudi Arabia and its fellow OPEC members, together with Russia, agreed recently to pump an extra 1 million barrels of oil a day to put downward pressure on the oil price. But sanctions against Iran and the collapse of the Venezuelan economy threaten to take even more out of the global market, pushing the price back above the $80 mark and threatening a further squeeze on activity and sentiment. The cost of Brent crude, the main non-US benchmark, fell 1.1% on Monday to $78.35 a barrel. On the corporate front, the big story so far this week has been the purchasing partnership between Tesco, Britain's biggest grocer, and Carrefour, Europe's largest retailer. The agreement is designed to use the two food giants' combined market power to squeeze better terms out of suppliers and so improve profitability in a sector that has been challenged in recent years by increased competition. The two companies will jointly purchase own brand products in a deal which will initially run for 3 years. Driving better terms from suppliers is seen as a better way to face the challenge from discounters like Aldi and Lidl than the price wars which have protected market share but at a heavy price on the bottom line. There'll be more on this theme, no doubt, from Sainsbury, which is due to announce a first quarter trading statement on Wednesday in an otherwise fairly quiet week for results. Purplebricks, the online estate agent, Topps Tiles and Superdry are also expected to announce earnings.
Please be aware the value of investments and the income from them can go down as well as up, so you may not get back what you invest. This information does not constitute investment advice and should not be used as the basis for any investment decision, nor should it be treated as a recommendation for any investment. Investors should also note that the views expressed may longer be current and may have already been acted upon. Reference to specific securities should not be construed as a recommendation to buy or sell these securities and is included for the purposes of illustration only. Fidelity Personal Investing does not give personal recommendations. If you are unsure about the suitability of an investment, you should speak to an authorised financial advisor. This podcast may not be reproduced or circulated without prior permission. It is meant for UK residents and does not constitute an offer or solicitation in any jurisdiction in which it may be unlawful to make such an offer or solicitation. No statements or representations made in this podcast are legally binding on Fidelity or the recipient. Issued by Financial Administration Services Limited, authorised and regulated in the UK by the Financial Conduct Authority. Fidelity, Fidelity International, the Fidelity International logo and F symbol are trademarks of FIL Limited.